Welcome back, financial friends, to Am I Catching a Falling Knife? The podcast where we sift through the market's turbulence to find out if a sharp drop is an opportunity or a warning. I'm your host, Dave, and today we're turning our attention to the skies, specifically to Southwest Airlines, ticker LUV. This stock has taken a pretty significant tumble recently, so the question on everyone's mind, and the very premise of our show, is, are we catching a falling knife? All right, let's dive into Southwest Airlines, ticker LUV. Now, over the last 10 days, LUV has seen a pretty significant drop, down almost 12%, specifically 11.91%. That's why it's landed squarely on our radar for Am I Catching a Falling Knife? Because when a stock takes that kind of hit, you've got to ask, is it a bargain or is there more pain to come? The dominant market narrative around Southwest right now is one of struggle. We're hearing about missed earnings, declining revenue, and challenges with some of their newer initiatives like basic economy and bag fees. But, and this is a big but, they've also got a substantial stock buyback plan in place, a cool $2 billion, which often signals management believes the stock is undervalued and offers some support. Now, who is Southwest Airlines beyond the ticker? LUV is a major domestic air carrier here in the United States. They're known for their short-haul, leisure-focused flights and a very consistent fleet, primarily Boeing 737s, about 810 of them as of Q2 2025. Interestingly, while the market narrative talks about challenges with basic economy and bag fees, the company's own profile states that these recent introductions have actually exceeded financial expectations without any operational disruptions. That's a key piece of information. They're also planning to introduce assigned and premium seating, which is a pretty big shift for Southwest for travel starting in early 2026. Financially, they pulled in $27.5 billion in revenue last year, but their free cash flow over the trailing 12 months is actually negative, around $484.74 million, and they're sitting on about $7.99 billion in total debt. Most of their revenue, 91.7% to be exact, comes from passenger fares, all within the U.S. So, with that backdrop, let's talk about the real impact, the earnings. This is where the story gets really interesting, because we have a slight conflict between the general market narrative and the company's own statements. The narrative suggests declining revenue year over year and an ongoing struggle. Based on that, we initially estimated a baseline revenue decline of about 3% for the upcoming quarter. However, as I just mentioned, the company profile explicitly states that those new bag fees and basic economy product actually exceeded financial expectations. So, we believe that positive contribution will offset about 1% of that potential revenue decline. This brings us to an estimated net revenue decline of approximately 2% for the upcoming quarter. And since 91.7% of their revenue is from passenger fares, that's where this impact will be primarily felt. Now, here's the kicker for airlines. They have high fixed costs and significant operating leverage. What does that mean? It means a small change in revenue can lead to a much larger, disproportionate change in net earnings. Based on industry characteristics, we're applying an estimated leverage multiplier of 6.5 times. So, that 2% estimated revenue decline, when you multiply it by 6.5, translates to an estimated 13% decline in quarterly earnings. While that $2 billion stock buyback plan is definitely a positive signal from management and could support earnings per share, it doesn't directly improve the operational earnings from revenue in the short term. The range for this estimate, by the way, is between a 9 and 17% decline, primarily because the narrative didn't give us a precise Q2 revenue decline percentage, and there's always inherent variability in airline leverage. All right, so what does all this mean for LUV's value? To figure out what this stock is really worth, I'm looking at it from two angles, using data I pulled from finviz.com. Currently, LUV is trading at $33.21. First, a discounted cash flow or DCF model. This is a robust way to estimate intrinsic value. Our assumptions for this model include a growth rate of about 50.5%, which is their EPS growth next 5 years estimate, a discount rate of 9.5%, and a terminal growth rate of 2.5%. With those base assumptions, our DCF model gives us a base value of about $57.65 per share. But when we apply the impact of our earnings narrative, that estimated 13% decline, our narrative case DCF value comes down to $47.85 per share. Now, the second method is a bit simpler, a PEG-based valuation. PE stands for price-to-earnings ratio, and it helps us assess whether a stock's price is reasonable given its earnings growth. Based on LUV's current PEG of 0.99, this method gives us a fair value of about $50.71 per share. So, both of these valuation methods suggest that LUV might be undervalued compared to its current price of $33.21. However, the market is clearly reacting to those struggles. If this knife keeps falling and you're looking for potential entry points, some custom buy levels we've identified are $25, $20, and even $15. So, wrapping it all up for Southwest Airlines, LUV. The stock has dropped significantly on the back of missed earnings and revenue concerns, but it's not a clear-cut story. As always, remember, this isn't financial advice. It's an analysis to help you make informed decisions. Do your own research, connect with your financial advisor, and make the best choices for your portfolio. Thanks for tuning in to Am I Catching a Falling Knife? I'm Dave, and I'll catch you next time.